Hello, chart watchers, and welcome to this Tuesday, July 30th, 2019 Market Watchers live show with your host, Tom Boley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the Fed is underway. That meeting is underway. We'll get an announcement tomorrow, but currently we got the Dow Jones Industrial Average down 72 points, the S&P 500 down 12, the NASDAQ bouncing off of earlier lows, but still down 32 points. Russell 2000 having a good day on a relative basis, was down quite a bit, but is rallying back. A close above that 1580 level would be bullish. Currently, the Russell 2000 up 6.5 points. 10-year Treasury yield also bouncing back after being down below 205 earlier today. It is back to about 2.07, up 1.5 basis points. Volatility index continues to within the downtrend, although it is higher today, up about 6%. Still, though, below 14 level and below the double tops that we saw back in earlier in July. Real estate and consumer staples leading again today. The market has been very defensive here yesterday and today ahead of the Fed meeting. Not too surprising given the fact that the market maybe was a little disappointed with what the Fed did back in the fourth quarter of last year. And so we await to see if the Fed will cut rates like I think most everyone is expecting. Materials, you can see having a pretty strong day today as well. But on the flip side, while defensive groups are having a pretty good day, the aggressive groups not so much. Technology is the laggard today. Been in a nice uptrend. We're seeing a little profit taking again ahead of the Fed. Kind of makes sense. Within consumer discretionary, home construction having a very good day. We'll talk about pending home sales, but that was a really good report this morning. Again, we'll talk about it in a bit. Home construction up very nicely today, about 2.5%. Computer services, not so much. Computer services to the downside. And here are two companies within the space. IT, which is Gartner Group, you can see down about 20% today, whereas Ring Central, on the other hand, came through with a tremendous earnings report, beat on the top and bottom line, raised guidance across the board, stock having a huge day. And then finally, Under Armour. I thought this company was going to have a better report than it did. You can see the big gap down. Wall Street not really liking what's going on. Under Armour was a big relative outperformer heading into its report, at least within its space. The space hasn't been good, clothing and accessories, but Under Armour had been one of the leaders heading in. So this doesn't bode well, I don't think, for that group when the leaders are struggling to meet their estimates. All right, Mary Ellen, I always think it's Friday. Is it Friday again already? You're back.
Oh, sorry to say, Tom. It's only Tuesday.
For those of you who don't know, Mary Ellen always joins me on Fridays. We do the What's Hot, What's Not. And so it's always a pleasure to have you on the show. But I thought for a second it was Friday.
Little head fake there. But it's quite a busy week. The markets seem to be certainly on edge. So everyone needs to stay on their toes.
Yeah. We do have a special guest, Dave Nadig, coming in today from ETF.com. Dave, how are you doing today?
I'm doing great. Seems like a relatively placid day in the market, as long as you're not the Gartner Group. So it seems like a good day to be on.
Yeah, that is true. What a day that company's having today. But that just goes to show you they're in the same industry group, and yet you've got one getting hit to the downside and the other one, riding high. And it looked like Gartner Group was trading pretty good into, I think it was an earnings report, but
It was, yeah. And they were hitting new highs yesterday and got walloped today.
Wow. Shocking, actually, to see a company trade like that and then get hit.
Yeah, they came in ahead of estimates and revised. I think it's the revision to their views going forward is what really got them.
Okay. Yeah, I don't think I was just pulling it up here on a relative chart, and I'll show everyone this in just a bit. And they were both kind of downtrending a little bit from their relative highs, but anyway, the reactions to both those reports quite a bit different. But again, we'll go over that in just a minute. Dave, we are going to come back. I know you got a great presentation that's ready for everybody. We're going to start that in about 10 minutes, so just hang in there with us.
Super.
All right. Mary Ellen, what you got? What we got today?
Yeah, so let's take a look at the upcoming schedule. Tomorrow, Jake Bernstein will be in, and on Thursday, Roman Bogomazov will be here. And Tom, you're going to do August seasonality on August 2nd, so that will be wonderful on Friday. Next week, a big week. Carl Swenlin will be here and John Murphy, so stay tuned for that. Today, of course, we have Dave will be with us, ETF Corner, giving us wonderful tips there. 10 and 10, go ahead and get your ticker symbols in if you haven't. Tom will be reviewing 10 stocks in 10 minutes. And that is the upcoming schedule.
Awesome. All right. Well, we are going to jump into economic reports. There were a bunch of economic reports actually that came out this morning. You can see June personal income better than expected, personal spending or consumer spending, matched estimates. May Case-Shiller home price index a little bit below expectations. July consumer confidence came in well ahead of expectations. And then, as I mentioned at the top of the show, June pending home sales, in addition to having a really strong month in May, absolutely blew the doors off the estimates here, rising 2.8% in June. Market only expecting 0.5% rise. And so that certainly lit a fire under the home building group. But before we get into that, let's take a look at the 10-year Treasury yield, because the 10-year Treasury yield has continued to move lower, and it's been doing this for quite some time. I'll even stretch this out a little bit, but you can see it goes back into the fourth quarter of last year. October and November, we put that double top in on the 10-year Treasury yield around 3.25%, and we have been just scooting lower ever since. We do have a Fed meeting, though, today, the meeting is today and tomorrow. The policy statement will be out at 2 p.m. tomorrow afternoon, and that is when we will find out what the Fed is going to do. I think the Treasury market has certainly been sending a message to the Fed to cut rates. For a while, there was talk of maybe a 50 basis point talk or a cut. And I think that maybe has been cut a little bit down to maybe 25 basis points. We'll see. I actually still believe they should cut 50. I think that inflation is not a problem. It's below target levels. I think that they have room to do the 50 basis point cut, but my gut tells me that they are going to do 25. Anything other than 25, I think will really get a big reaction out of Wall Street. And if they decide not to cut it all, that I think would be a real problem for equities, but we shall see, and we'll know more tomorrow. But again, watch this trading range here. To the downside, 195, 1.95%. Top side, I'd be looking 215, maybe up to this 217, 218 high that we saw back in the second week of June. But for now, we're just kind of range bound. To break above those recent two highs, though, I think would be very bullish for equities, because it suggests that money is rotating out of treasuries. And that would be a very, very good and bullish development for the equity market. All right, as far as earnings go, there are just a ton that are coming out this week and next week. You can see on your screen a number that reported. Illumina reported last night. The others reported this morning. Most reported pretty strong numbers. After the bell, we've got a couple big ones. Probably have heard of the company, Apple. They will be reporting at right after 4 o'clock today, and I'm sure traders will be trying to anticipate what is going on there. First thing I'll show you is that Apple chart, because Apple, I think, is trading like we're going to get some pretty good numbers. We will see whether or not that happens after the bell, but you can see here we've been trading up since that June low. We are testing overhead resistance, and if we go and take a look at the relative strength chart, you will see not only that computer hardware has been going up, but Apple has been going up faster than computer hardware, faster than the S&P, and computer hardware has been actually outperforming during this rally. So I think things are lining up for Apple, but we do have overhead resistance. So if we don't clear it with this, if earnings aren't the catalyst, then I think you may see some additional selling take place. But my gut is I'm going to go with Apple coming in ahead of estimate. That is normally the case, and so I believe we're going to get that gap up. Illumina reported earnings, and Illumina had already warned, and you saw the huge move down back a couple of weeks ago. Well, today they came out with their actual numbers. They did beat on their bottom line. Market doesn't seem to care. I said back on this gap down, I believe Illumina is going to head back to test this 270, 275 area, and I haven't seen anything since that gap down that would convince me otherwise. So that's what I would be looking for. Other earnings out there, let's see. We had, one company that I didn't have on the screen, Beyond Meat. This company had a huge rise. You can see the IPO was priced way down here. It opened about $45, $46 a share, ran up to $240 before its earnings. They missed their bottom line. They raised guidance, and then they had a secondary offering. So traders are really trying to put together all these different pieces to try to figure out where this stock goes. It gapped down, it rallied. I think it's probably going to move back down again. I don't know. Anytime you get the overhang of a secondary offering and the fact that they missed their earnings estimates, that probably would convince me maybe to stand on the sidelines. But we'll see. If Beyond Meat can get back up, break above 240, I think that would be a bullish development there. MasterCard reported before the bell this morning, and you can see pretty nice action here. It continues to move up. It's performing very well on a relative basis. Its group is broken out. I don't really see anything wrong here, and they did come out and beat on their bottom line, $1.89 versus $1.82. So pretty good action here on MasterCard. Procter & Gamble beat on their bottom line. Really nice reaction here. This comes on the heel of three white soldiers. If you're a candlestick fan, a really nice bullish pattern there. And we did confirm with the earnings report the catalyst to really get us this breakout. Look at the volume coming in. I would say Procter & Gamble, even though it is in the defensive area in consumer staples, you can see breaking out versus its peers on a 52-week basis, and also versus the S&P 500. So this is a stock that's leading, even though it is one of those defensive stocks. Merck, I actually expected a good report out of Merck. We got one. The stock gapped up. It's pulled back. You can see a little bit of indecision today. But when you look at the relative chart, Merck, relative to the pharmas, was actually at a 52-week high before this earnings report came out. So I would have expected this push to the upside, and we're getting it. The two stocks we mentioned at the very beginning, Ring Central, here was the relative strength. It's been going up versus its peers for quite some time. Same thing relative to the S&P. I expected a good report, and we got one. Big gap up, heavy volume. I think Ring continues to be a stock to own, especially on a pullback. However, we look at IT, and this one in the same space, I think looked just as good. Maybe not quite as good on a relative basis. We topped on a relative basis all the way back in November here with IT. But overall, the group was strong. The stock was breaking out. Clearly, they didn't inform Wall Street that they were going to be lowering estimates going forward, or maybe it was a recent development during their quiet period. But Gartner Group not performing well. I think this completely changes their chart. I think this is a character change for sure, and I would not expect too much out of this company going forward. Let's see. There was one other one I wanted to pull up here. I think it was Altria. So we'll take a look at Altria, and you can see Altria has been downtrending going in on a relative basis to the tobacco stocks. It's near a 52-week low. They did come in with their earnings, which only matched estimates, and you can see the reaction here was negative. So I'd be a little careful with Altria as we go forward as well. All right, going into the dashboard, wanted to point out among the market or the scooter movers here, that Coty, C-O-T-Y, nice little move here. Let's take a look at the chart and explain a little bit about what's going on. Now, Coty, you can see actually, well, I probably should get running here, but Coty did make a big push here to the upside. You can see the move, but it's going to lose its scooter score pretty soon as we get, remember the rate of change goes back 125 days. Pretty soon it's going to be based on this. So anyway, for that reason, Coty is your scooter mover of the day.
All righty, Tom, very good. I'm going to go ahead and cover a couple of these upgrades and downgrades today. We're continuing to see a lot of the movement in upgrades relative to earnings reports. But this first one that we're looking at is Micron, MU, one of the bigger semiconductor stocks. We can see this gap up here late June in response to earnings, strong uptrend. Morgan Stanley came out and ended their bearish call on the stock, and it's really not responding quite a bit, but of course the markets are a bit muted going into the Fed call, but it is in a confirmed uptrend, finding support at this upward trending 10-day. Your RSI is a bit overbought, but that was one I certainly wanted to share with you. ZBH, this is a company that came out with earnings. Take a look at that gap up. Q2 earnings came in ahead of estimates. Stock is up 1% on the upgrade. This is the kind of action that you are going to continue to see with these companies that come in well ahead of estimates. Analysts come in, revise their estimates higher, which consistently will continue to spark that uptrend. Big volume on that gap up. Let's take a look at a couple of the downgrades. This is also earnings related. APPF, this is a small cap software stock, really got hit. They did come in ahead of estimates, but the earnings numbers were not quite good enough. Gap down, huge volume, but buyers are coming in on that gap down. However, the stock has broken below this red 50-day simple moving average on volume. RSI is now negative, as is the MACD. So the stock, while it is finding support here, it is definitely broken. One other large cap stock that did get downgraded is McDonald's. They came out with their numbers a few days ago. Very good same store sales. Earnings were quite robust, but it could be a case of valuation. McDonald's was hitting a 52-week high last Friday, so it was downgraded. Not a big reaction here. We are still in an uptrend. Your RSI and your MACD are both positive. Those are the primary upgrades and downgrades. You can check out the other names that were upgraded and downgraded this week as well. And we will be right back with Dave Nadig after this commercial. And welcome back. I'm very excited to introduce our guest today. He's the managing director of ETF.com. It's Dave Nadig, and he is going to share with us his many insights surrounding ETFs. It's been a very hot button topic here lately, new products being introduced regularly. So Dave, what do you have for us?
Yeah, I thought I'd do a couple things here today. I'm a longtime user of StockCharts. I think you guys are the best in the business at what you guys do. I think what we do at ETF.com is a really interesting parallel to what you're doing on StockCharts. And in fact, if you're an ETF.com reader, you may notice that we use embedded StockCharts charts all the time in our reporting. And so I thought I'd approach the due diligence problem, which is really the problem we're trying to solve, from a couple different angles that might be appropriate to your users. And I thought I'd start actually with a chart you guys just put up to just sort of show you what I think the natural process for a lot of investors is. And like I said earlier, if you guys have questions, please do just jump in. So we were talking just a minute ago, for instance, about Beyond Meat, right? This is a hot button stock that obviously had a really interesting IPO, has had a great run since. And one of the questions we get asked at ETF.com almost every day is, well, how do I get access to XYZ stock with an ETF? Which may sound like a bizarre question, but I think most investors realize that diversification is important. And when you are picking single stocks, you really need to understand how that impacts the rest of your portfolio. So it's reasonable for somebody looking at a sort of newer high flyer like Beyond Meat to be thinking about how they can own that in a diversified portfolio instead of maybe just participating in what could be a high flyer or could be a real dud, depending on how the market plays out for synthetic meat products. So one of the ways to do that, which is sort of one of my favorite things to do at ETF.com, is to actually use the ticker for the stock we're interested in based on the news to start discovering ETFs that might give me that kind of exposure. So the way you can do that really easily at ETF.com is either in the ticker itself. You can just type ETF.com/stock and then put any ticker you want, or you can find it through our tools and data here on a stock finder. And what this will do is bring up a page for Beyond Meat. Obviously, Beyond Meat's not an ETF. We have a little information here about how it's held, right? It's held in 22 ETFs at the moment. We can see who owns the most shares and who has the largest allocation. And we have a couple different ways of showing that to you here as well. So for instance, here we can see the largest single holder of Beyond Meat is the Renaissance IPO ETF in terms of how much impact it has on that ETF portfolio. If instead what you were looking at was, say, all the people who own the most shares, maybe you're a little worried that institutional ownership is too big or too small for the stock, and you're not really looking for an ETF. Well, that's what you can find down here in this section, and we can see Vanguard's small cap value ETF already owns 82,000 shares of Beyond Meat. Their core small cap ETF owns another 80,000, and so on. And I think this is a great shorthand for understanding how these big ETFs may be swinging the prices or even dampening the price movements of a particular stock that you're interested in. So I wanted to highlight that because I think this is an interesting bridge between the world of looking at the technicals and individual securities and then starting to get towards the ETF due diligence problem. So let me back up a second and talk about the ETF due diligence problem. Really, I think this is our ETF screener tool on our website, which you can get to at etf.com/finder. You can navigate to it from the front page. But I just want to highlight one thing on this page, which is the ETF results with no search engines is 2,286 ETFs right now. That's the ETF due diligence problem, right? They're just so many ETFs to choose from that figuring out which one might be right for your portfolio is a really hard problem to solve. And based on the conversations I have with investors and financial advisors, unfortunately, I think they're one of three things that people lean on instead of doing their actual homework when it comes to ETFs. The first one is, and probably the worst one, is they just buy the ticker they know. And I think that's a reasonable place to have ended up. Obviously, we all know SPY, right? It's the most liquid traded security in the world. It's the Spider S&P 500 ETF. So it's not unreasonable to reach for SPY if you were just looking to trade some quick S&P 500 exposure. And certainly that's a perfectly great fund. You're not going to get into any trouble by buying SPY. You're going to get the experience you expect. But that's not necessarily the case when we start getting out into other corners of the market. So for instance, if you're looking at gold, and here, let's go ahead and show you how we could get to gold. Let's go through our screener here and we'll go to classification, we'll go asset class, we'll go commodities, right? And then let's go down here into precious metals, or at least in this case, gold. So there are 19 funds tracking gold according to our screener right now. And you can see the largest one here by assets is in fact GLD. That's the ticker everybody knows. The problem with that is it's also about the most expensive and least efficient way to get access to gold. There are a handful of funds that are significantly cheaper here. I mean, BAR, this fund from Granite Shares, is 17 basis points. It's $500 million. It's a perfectly respectable fund. So you're effectively just throwing money away by buying the ticker that you happen to know. So that's, I think, mistake number one people make, which is just grabbing a ticker. I think the second big mistake people make is just buying the biggest fund in a segment. Now, in the case of GLD, that would put you in the same fund. But let's say we were just looking at broad commodities funds in general. Where would we end up? Okay, well, the largest fund here is the PDBC, right? That is an extremely narrow, diversified commodity fund with an optimum yield methodology that may or may not be appropriate for your investing. But a lot of people will buy it because it shows up on a list as the biggest fund covering a segment. So I think that's rule number two that I think is sort of misguided. And then I would say rule number three in due diligence that gets people in trouble is just buying the cheapest fund no matter what. Again, cheap is good. I think we all know and love Jack Bogle from Vanguard, and I think he beat it into our heads for a generation that we need to focus on costs in our investing. And that's true whether you're trying to find a platform to make a lot of frequent trades and you're looking to lower your commissions. It's also true if you're buying a fund to hold for 10 years or to put into your retirement account. But just buying cheap can put you in some interesting positions as well. So for instance, if I let go of all of these things and I just reset the screen, hold on a second, let me reset the screen. So now I'm back to all 2,200 ETFs and I just sort by the lowest expense ratio. Well, lo and behold, there are a handful of funds out there that now don't actually charge an expense ratio. They are effectively free. And these funds were created specifically to effectively push this gimmick, to push this idea of free funds. But you'll notice that these are very small funds, right? This SoFi Next 500 ETF hasn't ever had any additional creation since it came out. It's a growth fund that's $6 million in assets. The fact that it's free is probably not relevant to your portfolio. What the exposure is what's going to be relevant to your portfolio. So I kind of wanted to start by dispelling this idea that you can just focus on something that you know, something that's big, or something that's cheap, and let that sort of be the be-all and end-all of your ETF exploration. So let's talk about maybe a more logical way to do this. Let's say, for instance, that instead of coming in by trying to chase a specific stock, let's say we're coming in with, an attempt to get sort of our core emerging markets exposure, which I think is something most investors would reach to an ETF for instead of trying to build that on their own. So using our finder here, it's relatively easy. We'll just say we want to be in equities, and then let's just go down to location, and we'll say economic development is emerging markets. So that gets us every emerging markets fund that exists in the ETF universe. It's a whopping almost 200 funds. And so now we're presented with this list, and we could look at relative performance and say, look who's doing really well this year. Unsurprisingly, it's a bunch of triple leverage products, so we can get rid of those if we don't want them. We can go over here to leverage and inverse and say, no, let's not look at those. Narrow this list down to something a little more reasonable, right? And now we can say, okay, what's the best one-year performer in the emerging market space? And it is a China A-share ETF. Okay, well, that may or may not be appropriate for you either, but let's go ahead and see what this hot-performing emerging markets ETF is, right? So this is the CSOP FTSE China A50 ETF. And let's talk about what you see when you get to the screen. These are our fund reports, and all this stuff is always available for free. And you can get to these directly by ticker as well if you just type in etf.com/ in this case AFTY to get to the CSOP FTSE China A50 ETF. And what you'll see here is a few things. The first is you'll see this rating, and this D63 comes from our data partners at FactSet. The D is a combination of what we call efficiency and tradability. Those are sort of objective measures of quality, expense, tradability. And then the FIT score, which I'll get to in a minute, it measures sort of how plain vanilla this fund is. If it was 100, this would be the most vanilla version of emerging markets you can imagine. If it was 0, it would not even be in the emerging markets. So this is sort of down the middle. It's giving you some sort of exposure to its core promise here, which is the China large cap space. Below that, you've got a couple of different things. Our overview section here gives you a quick fund description, some insight from the analysts at FactSet, a quick rundown on how this fund does as far as its environmental, social, and governance scores. And then probably the information most people are looking for right out of the gate, things like its expense ratio, how big it is, how much it's trading, what kind of spreads you would expect to see. A little bit of basic portfolio data, what's the weighted average market cap of the holdings, what's the PE of the portfolio, what's its yield, how many things does it actually hold, and some information about the index that it's tracking. Below that, you've got a very, very simple performance chart here, certainly nothing to compete with our friends here at StockCharts. You can do some quick comparisons here if you wanted to, say, compare this to the broader emerging markets. You could punch that in and see a little comparison chart on how this is done. And in fact, this fund has crushed the general emerging market space since the beginning of the year. So that's interesting. Below that, you get some basic breakdowns on the portfolio. You can see this is predominantly a Hong Kong and China ETF. You can see its sector exposures. You can check out its top holdings. And then you get to some more interesting information about how the portfolio is run. This is the section we would call efficiency here. You can think of efficiency as what is the promise that this fund has made, and is it delivering on that promise? And what gets in the way of delivering on that promise? Well, exogenous risks. If this fund was, an exchange-traded note that had a sketchy counterparty, that would show up over here in the fund structure. Maybe it would have some unique tax implications. Say if it was a commodities fund, you'd see that here. And then over here, you'll see the expense ratio. And then what I think is the most important statistic that most investors don't know about, which is tracking difference. If you are an investor that's not used to investing in indexes, the idea of tracking error or tracking difference might be alien to you. But if you think about it, this is a fund that is promising to track an index. In this case, the FTSE China A50 Net Total Return Index. And it will either do that really well or it won't. But your nominal expectation should be that the fund will fail to match its index by however much it charges you. So, in the case of SPY, you would expect to get the performance of the S&P 500 total return minus the 9 basis points it charges. In this case, you would expect to get the return of this index, this FTSE China index, minus the 70 basis points it charges in expense ratio. And that's what these three numbers here do. The median tracking difference is how much did this actually fail to hit its benchmark by? And the answer is, well, in an average 12-month period, it's actually trailing its index by 91 basis points, which is worse than you would expect. So it's actually not doing a particularly great job in a median year of delivering on its promise. Worse, in its worst one-year period over the last 3 years, it's actually failed to hit its index by 1.6%. So it's really having problems in some periods. Now, in its best performing time, it actually came close to matching the index, meaning it did about 70 basis points or 0.7% better than you might expect. And this is, I think, a really critical thing for investors to look at, because I think most folks think that index management is just pushing buttons on a spreadsheet. But in fact, particularly when you get into corners of the market like China, there are a lot of decisions that have to get made about when to include a security in that index, about how to trade around a rebalance, about how you invest overnight cash from dividends, for example. All of those things feed into the opportunity for this tracking difference. So let's look at a fund that maybe has done better in a similar market. This is IEMG, which is the iShares Core MSCI Emerging Markets ETF. You can see right out of the gate, this looks like a better fund. It scores A100, which is obviously the best you can score in the system. It even gets this little analyst pick gold star, which is our way of sort of highlighting funds that are the best in breed, the best scoring funds in a given segment. And if we go down to the efficiency metrics here, you can see that this fund, even though it has a 14 basis point expense ratio, in its worst case, it's actually beaten its index by 5 basis points over the course of a year. In its best case, it's beaten its index by 38 basis points. So what could possibly be going on here? How is it possible that index funds are actually beating the market if in fact they're supposed to be passively managed? Well, again, like I said, it comes down to how this fund is managed in countless small decisions along the way, including things like, are the securities in this portfolio lent out to short sellers so that they can in turn short those stocks? Whenever that happens, there's revenue that comes back to the fund. You can see that over here where it says securities lending active and then what the split is back to the fund. All of those things contribute to positive returns for the fund that the naive index it's tracking doesn't get. So here we have a case of an extraordinarily well-run fund that even on its worst days is doing better than you would expect. That's what we mean by efficiency. This fund is delivering on its promises in spades.
And Dave, is that something, oh, pardon me, that you can screen?
Go ahead.
Can you screen for that metric, the performance relative?
Absolutely. Pretty much everything you can see on these pages is screenable from the sort of the broader screener that we started with over here.
Okay.
So over here on the left of the screener, as it loads, you can see there's just or nearly infinite quantity of these things that you can add and screen based on, performance, trading data, spreads, et cetera, et cetera.
Very good.
Those things also contribute very heavily to this letter grade at the top of every page. This A is basically a combination of how efficient and how tradable a fund is. And efficiency is really dominated by that tracking difference score, right? This is where the rubber meets the road. This includes the impact of the expense ratio. It includes the impact of rebalancing. It includes the impact of, say, optimization because the index it's tracking is complex. So this is, like I said, I think this is the most important set of statistics most investors don't know about or don't pay attention to.
Yeah, and didn't realize that short selling metric there where they can actually garner revenue from that. Interesting.
Yeah, and it's really different from fund to fund. We're looking at a BlackRock fund here, an iShares product, and the split there is that, for every dollar they make from securities lending activity, 80 cents will come to the fund and 20% or 20 cents will go to BlackRock. Now, that's not pure profit for BlackRock because BlackRock staffs a desk to manage this process. They have to then invest all the collateral, et cetera. So they have expenses associated with their 20%. So this is pretty much close to 100% of the profits being returned to shareholders. That's what you'll find, for instance, in a Vanguard fund. Vanguard is much less likely to engage in securities lending, but when they do, it goes entirely back to the fund shareholders, as you might expect from Vanguard.
Interesting.
And we track that for every issuer. This will be marked here. The second segment of this, which probably is more familiar to your viewers here, is our tradability statistics. Some of this is pretty obvious. It's things like, what does the book look like? We have a little book viewer here so you can see how this fund has been trading and how tight the market is right at this moment. But we also have the normal things you'd look at before you start trading. Average daily share in dollar volume, what the medians are, what the spread looks like, what the median premium discount, that is, how much does it trade above or below fair value on a given day. All of those things are baked in here into tradability. I think the important thing that you might not find somewhere else here is that we show this over time. So for instance, this chart here is showing the spread between the bid and ask on a time-weighted basis over the course of the last 6 months here. So here you can see that at times of sort of peak volatility, this might trade as wide, and I put that in air quotes, as 2 basis points wide, and at minimum it would be less than 2 basis points wide. That is effectively a penny, so you can't really do any better than that, and this is one of the most liquid funds in the world. So that's not that surprising. Premiums and discounts is, I think, something people often get confused about. Something like this fund, which is an emerging markets fund, owns securities that simply don't trade during the course of the U.S. day. So for instance, if this is owning Malaysian stocks, well, there's no hour of the day when the New York Stock Exchange and the Malaysian stock market are trading at the same time. So the fair value, the net asset value of this fund, when it gets struck at 4 o'clock today, is going to be based on stale data from when Malaysia closed 12 hours ago. And so you would expect over the course of any given day, as the markets open up overseas and then the markets open up in the US, there will be some drift between this advertised net asset value and what the market's really willing to buy and sell the ETF for. So seeing something like this, where you've got premiums and discounts of a 1% or 2% based on the trading day, that's actually pretty normal for any fund that's owning international securities. And you can sort of see that it's normal by looking at this over time, right? There's nothing here that would make you think that today is an outlier in terms of fair value. So that sort of sums up everything that we're doing here in terms of liquidity. And then last, we have a section that we call FIT, which is mostly a clever way to find an F that means portfolio analysis, because conveniently efficiency, tradability, and FIT add up to ET and F. And then the FIT side, we provide portfolio statistics against what we've considered a neutral benchmark. So what we did with our partners at FactSet is for every place ETFs compete, so in this case, core emerging markets exposure, we found what we think is the most boring benchmark you can find. One that's not taking any particular tilts, no particular risks. It's not large cap or small cap if it's supposed to be total market. It's truly the most generic index we could find so that you'd have a yardstick to measure all of the competing funds against. And so when we see IEMG in this case, you can compare this to this neutral benchmark, and you can see, by sector, it's extremely close to this neutral benchmark. When you look at all the various holdings, you can see the same thing by country. It's extremely close to this neutral benchmark. Even when you look at things like the number of holdings and the weighted average market cap of the portfolio, this is about as benchmark hugging as you can get, which for many investors may be exactly what you want. If you were looking for something that's trying to make a bet in the emerging market space, you might actually want to see more variation here. But what this lets you do is really get a sense of what this is going to do once it goes into your portfolio, right? You'll be able to see, okay, I'm putting in a fund that's got a PE of 14.2. Okay, well, that's well under the U.S. stock market, which is trading at 17. So I'm getting a little bit of a value play. And I'm getting a dividend yield of about 2.6. That's actually a little under the S&P. So I'm getting a little more yield while taking a little bit less risk there.
Very good.
So I think that's the.
We have a number. Oh, pardon me. We do have a number of questions before we run out of time.
Great. Well, I was just about to wrap up there. That's sort of the core of what we do here, which is showing people the efficiency, tradability, and fit of what they're after. So I'm happy to answer any questions in the time we've got left.
Oh, that's wonderful. One of the questions was, do you have any Canadian ETF listings?
So sadly not. I love the Canadian ETF market. They do some of the most interesting stuff in the global space at all. They were the first folks to list marijuana ETFs. My guess is they'll be the first place to list Bitcoin ETFs. They do more interesting stuff with options and trading strategies than we do here. But unfortunately, at the moment, our data set is exclusively U.S. listed products.
Okay. And then another question was relating to the 2 or 3 times bear and bull ETFs, how you would search that?
Sure. So that's actually relatively easy. Over here under features, we have leverage, inverse, and leverage ratio. So for instance, if you just wanted to go for triple leveraged exposure, you would say leveraged yes, and then leverage ratio, triple X. And there you get the 58 triple leveraged ETFs covering every corner of the market. You could also then, back in and say, I really only wanted the bond ones. And now you're down to the 2 that are tracking that. So that's how you can sort of quickly get your triple X leveraged daily 20-year exposure if that's what you're after.
Very good. And then another question was about factor-based ETFs. They were asking relative strength as an example that have a good track record with low fees.
Yeah, so fees would be the tricky part. So if we go to a specific ETF here, like what's it, FBT, I think is one of the Dorsey Wright funds. Nope, that's wrong. FTB. The short answer is funds that are doing particular factor exposures are going to show up in their relative sector, meaning if they're tracking total markets exposure, they're going to be in with all of the other total markets funds. So if you look here at the top of this fund, we've got emerging markets total market. If we click on that, we'll get a list of all of the ETFs tracking this, including the ones that may be going after a particular factor exposure. So if we look down here, we'll see, for instance, a dividend-based product. We'll see a currency hedge product. We'll see a factor tilt product. And all of these are compared sort of to that normal baseline benchmark. We are implementing, I don't know whether it's on this page here or not, you'll see us implementing over the next couple of weeks a factor tilts box from MSCI, which will help you understand whether or not this fund is particularly taking, say, a momentum tilt or a value tilt. And I think that will probably answer some of this. But those factor boxes will be showing up here in the next week or two with a partnership we're doing with MSCI.
Oh, that's very timely. And there was a question about showing all of the A-rated efficiency funds.
Sure. So again, we come back to the screener here. And there's one of the things you can pick here is just analysis. So you could go letter grade, show me only the A's. So these are the 392 funds in our universe that have an A rating. And again, you could then go in and say, well, actually, I only meant the equity funds, and you could narrow that down however you like. Or, I'm only interested in high dividend yield funds. So they are the 9 A-rated high dividend yield funds.
Very good. I think we have time for one last question here, and it is, how do you look at volume as it relates to ETFs?
Yeah, so that's an interesting question. So, I'll give you the pat answer and then the real answer. So the way you look at it is we show you all the volumes here in terms of medians and averages. I do think that it's important to pay attention to on-screen volume, particularly if you're an active trader. Averages should probably not be what you look at. Looking at medians, or even better, actually just looking at the chart to understand what the current volume pattern looks like relative to the past, I think is the most useful thing to do. I think there's a hidden question underneath that, though, which is, does that matter, right? Does the on-screen volume matter? And the short answer there is sometimes. Because ETFs tap the underlying liquidity of the things that they own, it is the case that if you're a large investor, you can put $1 million trade through in something that hasn't traded in 5 days. You do that by working with an authorized participant and working that trade to create new shares of the ETF. For most individual investors, that's not going to happen. You really are going to be reliant on the liquidity you find on screen. So unless you're trading in 50 or 100,000 share blocks, the short answer is the on-screen volume still matters.
Very good. Wow, we covered quite a bit, and it was, I have to say, very, very informative and eye-opening. Thank you very, very much for joining us today, Dave.
Oh, well, thank you for having me.
It was great.
Yeah, I just want to add too, I mean, there was a lot of information. And we'd love to have you back because I know you didn't cover everything. And I was flipping through the screening as well, looking at some interesting information. I think maybe next time we can talk about as well.
Absolutely. Happy to come back.
All right. Sounds good. Thanks, Dave, so much. And have a great day.
Thank you.
All right. Yeah, there was actually one area I was looking at. We don't have time to go through it now, but where you can type in a ticker symbol for a stock and it'll tell you all the ETFs that own stock, which I think is really cool.
Yeah, you bet.
All right, we're going to go ahead and jump into the 10 and 10, and we're going to start with our first stock, which is DR Horton, DHI. I actually like the stock. I'm just make sure I got the latest price here. It's trying to make a breakout, and what I like about the stock is it's up against resistance. If it can get through, and we see the volume beginning to come back in on this rally, which I think is good news. Also, what is good news is check out that relative strength on DR Horton relative to the home construction index. When you go back, we are currently at a level, if this holds into the close, we're at a 9-month relative high. So we're starting to see more money rotate on a relative basis into the group. And we know that the home construction group is bouncing off of its 20-week EMA. So I actually think home construction could be a good play from here. And DR Horton is quickly becoming one of the leaders again.
Yeah, looks great. Next one is the biotech ETF. It's XBI.
Yeah, it's surprisingly, you can see the biotechs have not done well in July, even though the market's gone up. And even though historically, July has been a great month for the XBI. But it is what it is. It's, we're not seeing that strength that we typically see throughout the summer month. And so as a result, I would be careful. I would probably only stick with some of the leaders in the biotech space if I was going to get involved at all. And I think the thing that you have to really pay attention to is the XBI relative to the S&P 500. And if we do that, take a look at it going back the last 2 years and on a line chart, I think you're going to see that on a relative basis, this has not been a good area of the market. So yes, you can find a couple of nuggets in there within the space that maybe you're outperforming, doing well, but overall the group is not doing well. So to commit to an ETF like this when we are showing a lot of relative strength would not be my strategy. I would have to wait and at least I'd want to see the weekly PPO turn positive, and that's going to take a while. This is the daily that's negative, but we would need to see the weekly turn positive. So I think as far as this goes, I think I would just continue to look at it on a relative basis. And the thing that would keep me out of the stock is this right here. I mean, since March, April, we continue to move lower. So I would avoid it.
Very good. Next one is a low-priced software stock, CLDR.
All right, CLDR. Yeah, I mean, had the big gap down. It's trying to get through this reaction high resistance around $6. I'll throw it up here on the relative chart, but here you can see the downtrend in play. Continues to go lower. Yes, it's been a little bit better of late, but still trying to get through a key resistance level. And what's really bad is it's in the software space, and software has been so strong. So you can see there, the reaction highs come up to about 6. That's where we are now. need to get through the 50-day moving average, and then throw on top of that just absolutely horrible relative strength. You're in a great group and still trending lower. I think there's so many better software stocks out there. I'd pass on it.
Okay, next one is AIG, American International Group, insurance stock here.
Yeah, AIG I think has been a really nice performer. You can see this is really what I like to see. All of these charts moving up from left to right across here. That's just a quick and dirty way of seeing if it's in a good group, if it's performing well versus its group, whether its group is performing well versus the S&P 500. And it is. I mean, it's doing very well across the board. So I have no issues here. I think maybe from a price support perspective, I'd maybe look right around that 54.25, 54.5 area. That's where we had topped. We broke out above it. We came back. We tested that area. And then you've got the 50-day moving average quickly moving up to that 54 level. So I'm going to say 54, 54.5 is good short-term support here.
Okay. Next one's hitting new highs after reporting earnings last week. AUDC, audio codes.
Yeah, audio code's beautiful move. Great volume coming in. And again, relative strength. Look at this relative to the telecommunications group. I don't see anything bad here. I mean, other than the fact that it's probably going to be a little volatile because it is a smaller company. But you can see we had the prior resistance. We gapped above it. Intraday came back down, but then quickly by the end of the day, we were back near the highs and we are continuing to go higher. I think this one looks really good.
Okay, next one's due to report on Thursday. It's Square, SQ.
Yeah, I like what's going on with Square. I think that their relative strength is beginning to turn back higher. That is a good thing. Talked a lot about it over the past week or so, and the fact that PayPal has been struggling and Square has been doing much better. You can see even today with the market down earlier, it has rebounded. It's back in positive territory. So its relative strength continues. This you can see since the June bottom in the market, Square has been a great performer relative not only the S&P, but also relative to the financial administration peers, its industry group. And so this one to me looks a lot better now. From a price resistance perspective, I'm going to grow even more bullish when we can get a breakout on Square up at about that 82.5 level. You can see all the tests up here, not able to get through. I think that a breakout here would confirm the bullishness.
I agree with that. Avid, AVID, is the next ticker. They're due to report next week, actually.
Yeah, Avid was doing really well. I haven't looked at it in a while, but yeah,
pulled back a little. Yeah.
Yeah, consolidate. I mean, it had a huge run, went from 4.5 to 10.5 in 2 months. When a stock does that, you've got to give it time to consolidate before it makes another push to the upside. I think that's what we're doing here. It continues to trade well versus its peers, versus the S&P. And I think that the overall resistance level right here, which is the, all right, let's try this again. The resistance level, which I don't know why it's giving me two of them, but anyway, let's see if I can do it a different way. Here we go. So 1060 to 1070 right in there. I think we've got to get through that. And until we do, I think we could have, just more consolidation issues. Overall, not bad, though. It looks pretty good.
Okay, next one, big pharma stock, Eli Lilly, LLY.
All right, Lilly. Now, Lilly has not been performing as well on a relative basis versus the pharmas. I showed you Merck earlier and how it's been a great relative performer. Lilly has not. So I think before I would do anything, I would simply want to get through these moving averages. I think as long as it continues to trend down below the 50 and below the 20, I don't know that there's any reason to jump in. I'd want to see that change. So not a big fan. A great company, but not a fan because of its relative weakness and because simply there are others in the group that are much better right now.
Okay, next one is a gold stock, SBGL. It's a South African ADR.
All right, SBGL. Sibanye Gold. I don't know if I probably butchered the name there, but on a relative basis, looks very good. I'm not a huge fan of gold, but hey, if you got a stock that's outperforming the S&P 500, and if the Fed says that they're going to cut, I mean, that could help to weaken the dollar. And if you weaken the dollar, a lot of times gold will be a beneficiary. So you could certainly make an argument that short term, gold will continue to do pretty well. And this has been one of the leaders, as you can see, making the breakout. in the past couple of weeks, and on a relative basis, getting very close to that overhead relative resistance line. So I think stock looks pretty good.
Very good. The last one is a very attractive stock, KeyCorp, KEY. They actually reported last week.
Yeah, I think that there are others in the group that look better to me. We are getting close to about an 7-8 month relative high versus the other banks, but there's so many. I know Ally Financial is one that has been, one of my favorites in that group. I think we could probably look at USB. I know that's another bank that's been incredibly strong of late. So I think that this isn't a bad one. When I look at the chart and I look at the relative strength, it's certainly, there are a lot of others that are worse, but I don't think you're getting top of the line here. So I would not go into this one. I think I would be looking more at, like I said, USB or Ally.
Very good.
All right. And I believe that that is the last one. And so we should have that was the last one, wasn't it?
It was. That is your 10 and 10. Good job.
Yeah, so there it is. We got it in time. Got a couple minutes left in the, before we have to wrap up the show. So I think what I want to do is just give everybody just a really quick market update here. And you can see currently the Dow Jones Industrial down 63. So we still got that same weakness we had when we started the show. S&P still down, 12. NASDAQ down 31. Russell 2000, though, continuing to show relative strength. And we are getting very close to a nice breakout here on the Russell 2000. I want to see small caps outperform. So I think this is a good start to see some of the relative strength here. But we really need to see a breakout and show extended relative strength on small caps, which we haven't seen for quite some time. Volatility index continues to be a little bit of an issue here, rising last couple of days. But I think it's, again, as the market gets nervous heading into the Fed meeting, none of this is surprising me. I think the market has already had enough surprises by the Fed over the last 7 or 8 months, 9 months, and I don't think they're too anxious to go through another one. I don't know how you feel about that, Mary Ellen, but I know that I think traders are a little nervous with the Fed.
I agree. It's definitely a market that is on edge. And as we all know, monetary policy definitely drives market direction, certainly more than any other factors, even earnings. So it's going to be big. It's going to be. I read a headline that it's the most important week of the year, but I'm not sure I would call it that, but it certainly is going to be quite.
Yeah, that's a little dramatic.
Yeah, I thought so.
I wouldn't go there, but I would say it. I don't think it's that big a deal if the Fed does what the market's expecting. I think it could be a very big week if they don't do what the market's expecting.
And then, of course, their verbiage as far as going forward.
Yep. And remember, back in December, not only did they raise in December, but they talked about how they were going to continue raising in 2019. And that's when, literally right after that, that's when the market took that big tumble, right?
You're absolutely right. Yep.
So you got volatility moving up a little bit. I think the market's playing a little defensive here so far this week ahead of the meeting. And the Fed does have a history of kind of going their own way. I don't know. It's going to be an interesting meeting tomorrow.
Get ready.
Yeah, and I think I've read as many as 2 or 3 of the voting members of the Fed are likely to dissent from cutting rates.
There is dissension. Yes, absolutely.
This is very likely or very unlikely to be a unanimous decision by the Fed. So if Powell goes out, if they end up cutting and we get that announcement, I think it could go against the grain of what some of them are thinking, which, hey, we'll see.
That's what creates a committee, but yeah.
Yep, it is. All right, well, you can see the S&P 500. I thought last thing I would do is maybe just show on an hourly chart. I mean, we're pulling back, but my goodness, we've had a beautiful run. We've been in the, record territory across our major indices. Really, the only one lagging has been that Russell 2000. When you look at an hourly chart, really, what have we done since setting an all-time high? Pulled back 1%, less than 1%. I mean, really not that big a deal. So I think the market is anticipating we'll get what we want from the Fed. We'll see. Any thoughts as we wrap up the show? I mean, short term, what do you think the market just consolidates here?
Yeah, I think we're just going to be in this kind of edgy back and forth type of environment until that decision is behind us. And of course, we have the China trade talks taking place today, and any
Yep.
headlines there are only going to add to the volatility. So,
Yep. All right. I want to thank everybody for joining us today. I really appreciate it. As a quick reminder, Market Watchers Live now airs 5 days a week, Mondays through Fridays from noon to 1 p.m. So everybody have a great afternoon, and we'll be back here tomorrow. Happy trading.